Thank you for joining us for the 7 Secrets of Effective Farmers webinar series. We're grateful to have Alan Galloway from University of Tennessee Extension joining us as today's instructor. A few housekeeping items before we get started. Please leave your microphones on mute and video off during the session. If you would like to now locate the chat box, please type your name and location into the box to help me record attendance. You may use the chat box at any time during the session to submit a question. I am recording the session and plan to post it online. So if you'd like to view it again or share with somebody else, you're welcome to do so. I will ask you to answer 2 questions at the end of the session to record feedbacks. So if there are no questions at this time, let's dive into today's session. Alan?
All right. Thank you, Iris. Good morning, everybody, at least those of you that are in the Central Time Zone. If you happen to be in the Eastern, I'm sorry, I guess it's afternoon already. But anyway, we've got a good variety of information I'm going to try to share this morning. I will emphasize a couple things on the front end here. As you've noticed my title on the lead-in screen, I'm not a CPA. I'm not a professional tax preparer. I have assisted with tax seminars, teaching them for at least the last 15 years. So I've been involved in it, but I do quite a few returns myself for family. But I will offer this to those that are listening today, that if you have a question that I don't touch on, or you've got something specific you'd like to ask that you don't want to share with the group, I've got my email posted there at the beginning. Make a note of it, and I'll be glad to try to get you an answer to your question if I can at all, or at least I'll let you know where to find, hopefully, the source of information that might answer it at best if it's something that we don't cover today. Because obviously in a limited hour, I can't cover everything, but we're going to hit on a few fairly important topics. I hope that will enlighten a few things along the way as far as that goes. So let's jump on into it. I want to start off with a few general thoughts on taxes and records, as we say. I think the obvious thing, of course, that there's a lot of folks that miss out on a lot of tax deductions just from the simple fact that their records are insufficient to provide them with enough information to make sure that they have covered everything that they could have included on their tax return as far as those expenses, those deductions that they do qualify for. I know the few folks that I help with, it seems like every time you ask them, is there anything else that you might have forgotten, they can almost always come up with, oh yeah, can I deduct this? Will that qualify? Those sort of questions. So there again, a good record system provides you with good tax planning information. But those of us that work with the Manage program here in Tennessee, I always like to emphasize that those records also could provide you a lot of tools to use for long-term planning. And that, of course, having those records can help you determine whether or not you've reached those long-term goals when you do get there, and of course, will help you adjust those as you need. For those of you from Tennessee, just wanted to emphasize that our Manage program that both Iris and I work with, and 7 other area specialists across the state, we help farm families develop those long-range plans, look at individual budgets if they need to, or in many cases, help them establish better record-keeping systems if they're interested in that. And for those of you in Tennessee, of course, you can check your local extension office if you'd like to meet with one of us, or you can email us through the UT Extension website, either one, or give us a call, whatever. Anyway, that's some general thoughts. Let's get into what we're going to try to talk about today. I've got a lot on my list that I'm going to try to cover. And obviously in an hour's time, it's going to be tough to do a lot of detail on some of these, but I felt like they were important enough topics we at least ought to touch on them. So we're going to look a little bit at current tax law issues, and obviously with the current environment of this country, of what we're dealing with the coronavirus pandemic that has changed things drastically. There's a few things there I'll throw in as well that could be of some information. I want to spend a good bit of time talking about livestock sales, because we have encountered some significant record issues with folks submitting their livestock sales incorrectly that may be costing some livestock producers causing them, you might say, to pay extra taxes that they don't need to be paying. Talk a little bit about depreciation, the issues with the bonus depreciation, Section 179 and such as that. I'm going to spend a little time talking about what IRS auditors are looking for should you ever be audited. What are they checking for to ensure that you are truly a farmer that is trying to be a real farmer and not somebody that's just out there as a hobby as what they're usually striving to prove you are sometimes, or it looks like they're trying to prove that so that you wouldn't qualify for farm deductions. But touch on that a little bit. Got a few tax reducing tips that I'm going to cover in just a variety of items related to farming. Talk a little bit about like-kind exchanges and how that has changed due to the tax law that changed 2 years ago. Also spent a little time on the qualified business income deduction that started back in the last year's return, not this one, and a little bit of information on net operating losses. And then I'll venture a little bit away from income taxes and talk about some other taxation issues that I think are worth sharing today. And I'll wrap up with some talk about records in general. And then, of course, if as Iris may have mentioned, if you've got questions, you can throw them in the chat box. If we have time, we will get to those. If not, we will try to answer those separately later. Well, let's talk about the current issues first. Obviously, with the coronavirus pandemic, the federal folks decided to delay the filing deadline for your taxes for your 2019 return until July 15th. If you've already filed, that's great and wonderful. Hopefully you've already got your refund, or if you had one coming, or you've already sent your payment. Initially, when they passed that first information along, it looked like they were only postponing the payments, but then luckily the IRS did come back and clarify that the filing deadline was extended until July 15th. However, let me emphasize that if you have not filed yet and you are about ready to file, go ahead and do so, because that extension of 3 months only gives these scammers and folks that are out there with nothing else to do right now except try to break into your computer or steal your ID or whatever. It might prevent them from filing a return before you do. And a lot of folks have run into that in the last few years. So there's no reason to delay. You can still delay the payment. You can file now, but delay that the payment is not taken out of your checking account or wherever until July the 15th. So it can be set up that way when you file your return. Other things I wanted to highlight here was that the states that border Tennessee, obviously we're fortunate here in Tennessee that we do not have an income tax, but practically every state that touches Tennessee, and I know many of the others across the country, have an income tax, a state income tax. I have found that those state deadlines do vary. Of the states that touch Tennessee, all have extended their deadline of filing for taxes until July 15th, except 2 of them. Unless it's changed in the last few days, Mississippi is extended only to May 15, and Virginia is extended to June 1. Now, Virginia's normal filing date is May 1, but they extended it 1 month to June 1. Now, that's not to say they still couldn't choose to extend it further, but those states that have, obviously, if income taxes are a majority of their revenue generation, then obviously extending that date cuts into their pocketbooks pretty hard. And so that for them to be able to keep functioning, many times they couldn't delay it much further than they did, but a majority of them have extended on to July 15th. A few other things on this page, just highlighting some things you probably already know are standard deductions for this year, for the 2019 filing year that we're working on taxes now for. Single standard deductions at $12,200, married filing joint is at $24,400, and head of households at $18,350. Now, I emphasize again that personal exemption equals 0 because, as you recall, when they changed the tax laws in 2017 into 2018, with that change, when we filed our 2018 return, the old personal exemption was basically gone. And that was one of the reasons they increased the standard deduction up as high as they did. And realize now that looks like that penalizes a family, especially a large family, but they increased the child tax credit deduction. And so that kind of offset that loss of that personal exemption that we used to have, that we figured into taxes. Actually made it a little bit simpler in a lot of ways, because by increasing that standard deduction, a large majority of the taxpayers now use the standard deduction instead of trying to itemize their deductions, which of course takes a lot better records and a lot more time to put together. So that simplified the tax returns for a great majority of the people out there. I just listed a few of the tax rates just to make sure we're all on the same page with those. Right now, the 10% rate is up to $9,700 single, $19,400 for married filing joint. Obviously, that would be that amount above the standard deduction of the $12,200. So after you subtract the $12,200 to come up with the actual taxable income, in most cases, and other credits you might have, of course, would factor into that. Then you come up with where you're going to fit into the tax rate thing. 10, 12%, the 22%, obviously I've listed there the main three that the majority of us folks fall into. If you're fortunate enough, I guess you might say, to be in one of those higher tax brackets, that I'm tickled for you, I guess you'd say, but that creates other challenges, and I didn't eat up the space listing all the ranks up on those, but we do still go as high as a 37% tax bracket. The other thing that comes into play that was changed a little bit a couple of years ago is what they call the SALT deduction. That is the deduction for state and local taxes, and those can be either income taxes or sales taxes. And they set that maximum at $10,000 for a married filing joint, or $5,000 for a married filing, or I got MFS. That should be for single, not MFS. I got a little typo there. But anyway, for single, it'll be 5,000, 10,000 for a married filing joint. That obviously creates a little bit of an issue for states that have extremely high income tax rates, but it does still give a break for individuals that are itemizing, that they can itemize up to that $10,000 level for state income taxes or state sales taxes, if that's the situation you're running into. Now I want to jump on into my first major topic, and that is one, I'll get on the right page here, related to sales of livestock. And I'm going to spend a fair bit of time on this one because we have identified, especially in the last couple of years, that there is a substantial number of folks that may be incorrectly reporting sales of their livestock, or at least part of the sales of their livestock. I'm going to give my examples as if we're talking only about beef cattle here, but this would be the same whether you've got hog, sheep, goats, whatever it might be, any livestock, as far as that goes. Only exception might be chickens in some cases, because they don't have the same classification as the other types of livestock. Horses could fit into this as well, of course. Basically, when you're looking at sales of livestock, there are two major types. You've got if we're talking about beef cattle, you're talking about the calves that you sell, whether they're calves that you might raise or calves that you might purchase and then resell later at a heavier weight. Or you've got the other type of sales is breeding livestock, and those are those animals that are raised or purchased simply for the purpose of breeding. Now, the one clarification I want to put in here, if you're in the business of raising breeding livestock, this what I'm going to talk about may not fit exactly there, because the purpose of the breeding livestock begins with that individual that bought them or raised them to use them for breeding purposes. If you're just raising them to become breeding purposes, to sell to somebody to be their bull or their heifer or their cow, then that changes the picture just a little bit, and those classifications would be sold more like the calves, as you'll see as we go through the examples in a few minutes. So basically, your breeding livestock are generally those heifers, cows, bulls that's in your herd that you're using for breeding livestock. You may have some of those that you raise that heifer from birth all the way up through to become, the cow that's joining the herd. Or you may have purchased a bred heifer or a cow, and then that cow joins the herd. And how all of those are handled should be handled differently from the calves sales, and we'll get into the details on that in a moment. I do want to emphasize that I did assist in writing a publication here in Tennessee. It's on the UT Extension website. It's publication D42, called Livestock Sales Understanding Tax Impacts, that covers this in a little bit more detail, but hopefully would answer questions if we don't get to it today. I'm going to walk through a few pieces of information. Number one I want to look at is I'm going to show you pop-up, and I know this is small, but this is you might say a shrunken copy of the good old Schedule F, the profit and loss for farming form that you would file for this year's taxes for the 2019 tax year. As you can see, part one is where all the income is included on that, and that's where I'll talk in more detail about it in just a moment. Part two is where you list all the expenses, all the feed, seed, fertilizer, chemicals, animal health expenses, all those items that are related to the farm. Most of you are familiar with those. And of course, a lot of folks don't fill out the forms anymore because we've got the tax software that helps us put in all that information, and then it puts it in the blanks that we need it in, or your tax preparer is doing that for you. But sometimes it's good to look at the forms just to make sure we're not missing out on something that we haven't forgotten about. And there's a lot of different places. And I want to switch to this next screen, which is a larger version of just that part one of that Schedule F, dealing with just the income side. And I want to emphasize here that the main places for livestock sales on Schedule F, I'm going to say this probably more than once this morning, only your calf sales, or if you're in the business of breeding livestock, would they go on Schedule F? Typically, your other breeding livestock in your herd, your operation, do not go on Schedule F. And I'll cover that more in detail in a minute. But as you see there on part 1 of Schedule F, you've got sales of livestock, other resale items, which is lines 1A, B, and C. And this is for calves that you might have purchased and then are reselling. You would list obviously the income on line A, the cost of those calves on line B, and then the difference between the two, what you actually profited from the sale on line C and 1C. And we'll talk more about that in a minute. And then on line 2, it says sales of livestock, produce, grains, and other products that you raise. Calves that you raised from birth, obviously the sale or income from the sale of those goes on line 2. The place we sometimes see folks report to their tax preparer that I had so many dollars of cattle sales. Well, the tax preparer then doesn't know where that income came from unless you break it down for them. The other place we sometimes see income show up is down under line 8, which just says other income. And I have seen folks include cull cattle income there, and it should not go there. It goes on a totally different form, as you'll see in a minute as we cover the rest of this information. Well, let me move on along to get some examples related to these livestock sales, just so we emphasize again where those go. Here, first example is Farmer A. He raised a group of calves up to about 500 pounds, and when he sold them, the income, as we already talked about, goes on Schedule F, line 2. The marketing expenses, any transportation costs of those expenses, or all the costs involved in raising those calves would then be shown in the lower half under the expense section of Schedule F. And that would be basically how that sale would take place. So again, just to look back at again, that same form, sales of livestock that farmer raised, all that income would there show on line 2 for those calves that he raised. Example number 2 is a similar situation where Farmer B sold a group of calves that he had bought. He purchased the calves when they weighed about 250 pounds, sold them when they reached about 500 pounds. The income from that, as we've already mentioned, goes on lines 1A, 1B, and 1C. The income goes on one for the gross income from the sale goes on line 1A. The cost of those calves will go on line 1B, and then the difference, of course, goes on 1C. And again, of course, the expenses involved of the feeding, care, marketing, transportation involved with that group of calves would be included with other farm expenses shown on the expense side. And there again is the copy of the form where they'd be using lines 1A, B, and C for those calves that was purchased. Again, back to our grown up portion, the important thing that I'll hear mentioned, I know more than once as I go through this, is the Schedule F income is important to be calculated and included correctly, because Schedule F income and the profit from that farm transfers, of course, eventually to your 1040, and that is included in your gross income, and that income is ordinary income and is subject to income tax as well as self-employment taxes. Breeding livestock sales do not go on Schedule F. And that's because of this information I'm now popping up, is breeding livestock is considered an asset, just like a piece of equipment that is on the farm. And they are not, the sale of breeding livestock is typically not subject to self-employment tax. So if we report them on Schedule F where they don't go, then we could be subjecting ourselves to paying extra self-employment tax that we shouldn't have to pay. And that's just part of the puzzle. But the breeding livestock, the tax treatment of them depends on a few factors. One, whether the animal was raised or purchased. That changes how it may have been handled in your tax records from day one. A raised animal, of course, when you sell it, you don't have what's called any basis or value in that animal, because you were able to deduct all the expenses of raising that animal while you were raising it, all the feed and animal health expenses and such as that. A purchased breeding livestock, a heifer or cow or bull that you bought, obviously at the time you purchase that asset, you can choose to depreciate that asset at that time, just like you would a piece of equipment. You don't have to, but you can take depreciation on animals that you, breeding animals that you've purchased. So then when you sell it, that changes how the tax records are handled there, and I'll walk through a couple examples in a second to address that. The other things related to breeding livestock that changes their tax situation is how long you have owned the animal, how long it's been held on the farm. For cattle and horses, if they're owned 24 months or longer, they're considered a long-term capital asset, which changes it may fit them into the long-term capital gain situation rather than short. And then, of course, whether or not the sale of that animal results in a gain or loss will be calculated in with the other items on that farm that sold on that tax return that year. Key thing here is the sales of breeding livestock should go on Form 4797, not at all on Schedule F. And that would get them on a form that would prevent you from accidentally paying self-employment tax on that income if it's a gain from the sale, or you have a total gain from the farm from all the sales of the assets at that time. All right, again, this is 4797. I'm not going to try to show that in whole form. It would take us too long to walk through it. I will emphasize that if you've got questions about that form in particular, you can get a lot of good information from the Farmer's Tax Guide that is created each year by the IRS. It's publication number 225. And of course, the instructions specifically for Form 4797 will explain as best they can where on the form those sales would be entered for the breeding livestock. Now, I'll walk through a couple examples just to show you how this may impact things. Number one, just back to our examples, Farmer C, let's say he had a cow that was 4 years old that he had raised and sold her for $1,100, and the expenses related to that sale was $125. Obviously, he reduces the net gain or net income from that sale, and he's going to have a gain of $975 on the sale. Again, this would be a long-term gain because he's owned that cow more than 2 years. Again, the income is not going to be subject to self-employment tax. Again, that gain also would be combined with other gains and losses from any assets, other animals or other assets, equipment or whatever that's sold that year. All right, now here we're going to get into a little bit more of a dollar example with pennies and put into the example, you might say. If Farmer D sold a cow that he had purchased 4 years ago, might make the calculation a little more complicated. Let's say that cow was purchased for $1,300 and he was fortunate enough to sell her for $1,250 4 years later. The amount of depreciation that was taken on that cow, let's say, was $867, and the expense of the sale was again $125. That may be the marketing and transportation costs, things like that, to make up that $125. The gain from the sale of that purchased cow would be calculated as shown on the screen. That he would take the original cost, that $1,300. You might say add in the expense of the sale, but subtract that depreciation that was taken. That would allow him to calculate an adjusted basis of what was the value left in that cow at that time, which was the $558. You subtract that $558 from what he got selling the cow at the $1,250, and he's going to have a gain realized on that sale of the $692. Now, part of this income may still be considered ordinary income. In many cases, it may not be what you would call capital gains income in all cases. Some of it may still be ordinary income, but it will not be subject to self-employment tax. So let me just give you kind of a what you might say the worst example that could happen if someone reported it incorrectly. So if Farmer D had reported the sale of that cow for $1,250 and he put it on his Schedule F instead of on Form 4797. And I'm assuming here that this farmer is already in the 10% tax bracket because of all income from all sources. It may be farm income, it may be off farm income that has got him to a high enough income level that he's just in the 10% tax bracket. So he's going to be, so that $1,250 that he got from that cow that's been reported incorrectly on Schedule F, he's going to pay 10% sales tax on, income tax on, excuse me, 10% income tax on. He's also going to be charged, if it's a profitable operation, for the farm return, then he's going to be charged another 15.3% self-employment tax. So over 25% tax on that sale, he's going to be over $300 basically in extra taxes that it could be costing that example. Now that's an extreme example. Most folks wouldn't be that hit that hard. It might only be the self-employment part. But the second note I want to point out here at the bottom of the screen is the fact that if the farm has a loss, and you're thinking, well, if I have a loss on the farm, I won't be paying any self-employment tax on farm income. That would be correct. However, if that sale of that cow or that breeding livestock is reported incorrectly, and let's think about this, especially if you've had a number of cull cows sold in that particular year, you might have had a farm loss, but because of those sales being reported incorrectly, it might now show as a farm profit on Schedule F, which might cause you to pay self-employment tax and income taxes that you wouldn't otherwise be due to pay because of the fact that it got reported incorrectly. So you would basically be making your loss, you'd be reducing your loss. So if a person has off farm income that they're trying to offset or hoping to offset because they did have a farm loss in that particular year, they're not going to be offsetting as much of that off farm income. And that might there in turn cause the farmer to be paying more income taxes than they otherwise would have. Again, a lot of details with this. I want to throw in a few more tidbits related to this that's important to know. And number one is, again, long-term capital gain period for most cattle, for cattle and horses, is 24 months. For other types of livestock, it's only 12 months. So your goats, your sheep, your hogs are only 12 months. Some other important rules to be aware of that I want to touch on related to this is there are some exceptions sometimes to this holding period rules, you might say, related to how long you have to own those breeding livestock for them to qualify as long-term. And one is there's some exceptions to the rules, especially for situations for things like weather-related sales of livestock. If you're not familiar with that one, let me explain it briefly. It won't take but just a moment. Basically, if a farmer has to sell additional livestock because of a weather-related event, be it drought or tornadoes or floods or whatever it is, something causes that farmer to choose to sell additional livestock. Now, by that I mean, let's say that in a typical year on this particular farm beef cattle operation, for example, that this farmer's typical year he culls out about 9 of his cows, and he in an average year sells about 10 of them. Let's say 10 cows in an average year. And in this particular year, because of a drought or whatever situation related to weather, he realizes he may not have enough grass or pasture or water or hay or whatever, and chooses to sell 15 cows in this particular year. The income from those additional 5 cows in this example, he would not have to claim as income in the year that he sold them if he can document that it's because of a weather-related event. And according to the IRS rules, he has up to 2 years to replace those additional livestock that he sold without having to claim that income from that additional sale. Now, obviously, if the replacement livestock don't cost as much as what he got out of those 5 that he sold, then he would have to go back and adjust his return from the year that he sold the 5. If the 5 that he bought, which most likely will be the case, will cost him more than what he got out of those 5 that he sold, those additional 5, then he wouldn't have to go back and adjust that original return from the year that he sold them. Wanted to mention that one in a little bit of detail because that weather-related sales of livestock can be a real beneficial tool in those years where it happens. Other things related to the holding period of the breeding livestock is, and these last two bring that to point, is if an animal is raised with the intent that it's going to become breeding livestock. It's a calf, a heifer you've raised up all this time, and now the heifers, for whatever reason, won't breed. It's been determined that the animal is sterile and cannot become breeding livestock. The IRS states that if the animal is sold within a reasonable time, it could be considered breeding livestock. So it wouldn't be there again. The sale wouldn't go on Schedule F. It would go on the Form 4797. I have been unable to find a definition of what the IRS calls a reasonable time. I think it would be logical that if it was, within a month or two of you determining that the animal's sterile, then that might be logical. If you kept the animal for another 6 to 9 months, you might say, well, maybe you've tried to fatten it up further to become more of a marketing livestock rather than a breeding livestock. So obviously, a little bit of leeway there on the reasonable time issue. The other point I wanted to make here at the bottom is that a farmer that is selling an entire herd of animals can generally consider younger animals that would have become breeding livestock as such for tax purposes. This could be very important to a farmer that might be retiring and selling out the entire herd at one time. That would enable you to classify some of those heifers that you were raising that would have been breeding livestock as such when they sell them out in that sort of situation. So basically what it comes down to is anybody reporting livestock sales to their tax preparer needs to break them down 4 different ways. They need to report to them the calves that they raised and the income from that. Any calves that they purchased and resold, they're going to have to report not only the income from it, but what they cost when they bought them. And then they need to separate the breeding livestock raised and the breeding livestock purchased to make sure that their accountant or tax preparer is recording them correctly on their Form 4797. And I emphasize again, make sure your tax preparer understands why you're reporting them this way. In the case that your tax preparer doesn't, you could show them that publication, D42, and maybe that will help them out. Or if they really don't get it at all, I hate to say this, maybe you need a different tax preparer. But let's just be honest about it. They could be costing you money if they don't understand as well as you do where that needs to go. All right, we've got about 30 minutes left, and I've got a lot more ground to cover, so let's jump into some of our other topics rather quickly here.
Could
Number one,
we just take one question?
sure, Iris, go ahead.
There's one participant ask, can you explain purchasing yourself for breeding or raising for yourself for breeding? Uh, he said, all right, she said, you said that one is treated like calves.
Oh,
Which one?
what I was getting at was that, oh yeah, I think I see the question now. If a person is in the business of raising breeding livestock, but that animal has not yet become breeding livestock. In other words, the farmer is raising that heifer, let's say, to sell the heifer to become breeding livestock for somebody else. So meaning that they're going to hang on to it longer than you would have if you was just selling it. Obviously, if you're selling market calves, you're going to sell them somewhere generally 500-700 pounds in most cases. You may take them a little heavier for your background in some of them. But for the person that's raising breeding livestock to sell them to another farmer to become breeding livestock on his farm, that sale does not qualify as breeding livestock for the person that sold it to the farmer that's going to use it to raise the calf when it has the calf. So the farmer that buys it, then whether it's bred already or not, or breeds it to then have calves on his farm, that farmer has the initial use of it being breeding livestock. So I hope that clarifies that one a little bit at least anyway. All right, moving on along. Depreciation, we did have a few changes last year on the taxes. New equipment can now be depreciated over 5 years, used to be only 7 years. So that was an advantage if we needed to depreciate things like tractors or other equipment quicker. Used equipment, unfortunately, is still 7 years if you choose to depreciate it. We do still have what's called bonus depreciation. And as you can see on the screen, it's a 100% bonus depreciation. It does continue through 2022. It is for new equipment only, which does allow farmers to write off, you might say, the entire cost of a piece of new equipment in the year that you buy it. That bonus depreciation supposedly goes away in the future. It'll drop to 80% in 2023, 60% in 2024, and then goes away in future years, unless, of course, the Congress decides to continue it at some point in the future. We do still have the Section 179 deduction, which many farmers use to, of course, to write off or deduct the cost of equipment. It does have a maximum, $1,020,000. That doesn't affect anybody except the larger farms, of course. A couple notes there, the Section 179 cannot create a loss, whereas other types of depreciation, or since this is a deduction and not depreciation, it can. The other types of depreciation can create a loss. A Section 179 deduction cannot on the farm. A couple other things are related to depreciation that's important to know is that small equipment now, any item that's under $2,500, you can choose to expense it rather than depreciate it at all. So you don't have to put it through either it doesn't have to be part of the bonus depreciation, or it doesn't have to be depreciated at all. Small equipment, those items under 2,500, you can choose to expense them out just like you do the feed and the fertilizer and the seed and those sort of items. A couple things I wanted to emphasize here that I think are worth reminding folks is that the purchase of an asset should be based on a need, not for a need for depreciation. All too often, I find some folks will say, well, I need to buy a new tractor so I can save on my taxes this year. Well, if that's the only reason you're getting the new tractor, that may not be the best reason in the world to buy the tractor. Often I ask them the question, will that new asset do anything to increase income on the farm, or will it reduce labor or other expenses by having that new piece of equipment that you're now depreciating? And with times as tight as there are on the farms these days, I think we always need to ask ourselves whether or not we really need that new piece of equipment versus maybe a used one or some other, patching up the one we've got. And I know that's always a great debate. Somebody asked the question, would small equipment under 2,500 be expensed as supplies? It could show up on the supplies line. I think that's where it typically will go. But I think they'll ask you a question on most of your tax software. Are you choosing to expense these items under $2,500? But typically under supplies, or it could go under small equipment that way as well. All right, moving on along. Went the wrong direction. Let's go the right way. I wanted to emphasize a little bit about what auditors are looking for, because quite often I'll get asked by folks, they've had a farm loss for maybe 2 or 3 years in a row, and they're concerned that they might be up for an audit, or that they might get audited. And that's not always the case, but realize that the IRS audits a very, very small percentage of all the returns that they do. It's what, less than 0.5% now. But they do tend to look a little bit at what they call hobby farms, or farms that look like they're being operated strictly to reduce the off-farm income that an individual might have. So they will look for those individuals many times that have a very high off-farm income, and if that individual owns a farm and that farm continues with a loss, then they're going to start questioning it. The other things they look at, I've tried to list here, is one, they look for a proof of a profit motive. Is this farm being operated in a way that it should or could become profitable? They look for things like, does the farm have any sort of a business plan or farm plan that shows that in time, even if it's not profitable for a period of years, that it could become profitable? They also look for things like separation of records or separation of accounts. Does the records for the farm, are they intermingled with the family's home records, their personal records or personal accounts? Is it all handled through one checking account, or does the farm have a separate checking account from the family expenses? They do look for things like that. They look for things like, is there any continued education on the part of the farmer? Is the farmer trying to learn more how to do a better job farming and improve their ability to make the farm profitable? Things like even attending this webinar today. And then, have changes been made? Have things changed? Is the farm being operated the same year after year after year and still remaining having a loss every year? Or have changes been made that could help it to become profitable? They look for those things as well. But that's just some of the high points there I wanted to mention of what things auditors are looking for should you ever be called to an audit. Hopefully you won't, but it could happen, unfortunately. And it's usually something else that causes a farmer to be called in for an audit, and then of course they look at the farm records as well. All right, let's get into some other tax reducing tips that I think are worth talking about a little bit, at least highlighting to you in case you hadn't thought of them. Many of these you may have already be doing or have thought of in the past. One possible use of or way to reduce some from taxes in a particular year is by prepaying some expenses, prepaying for things like feed, fertilizer, seed, chemicals, things like that. So for an instance, if you had a high income this year in 2020 and you knew you needed some other expenses might reduce that, you could choose to purchase ahead of time this fall, let's say, some fertilizer that you won't use until 2021. It does emphasize that it has to be a purchase of an item, not a deposit for an item. So in other words, when you go to the farm supply store, the receipt can't say that you put a $10,000 deposit down towards your 2021 fertilizer. It needs to say that you purchased a certain number of tons of a certain type of fertilizer. Now, that's not to say that the spring of 2021, you couldn't choose to have a different blend of fertilizer bought out and delivered to the farm. It just says that on that receipt that you're going to use as a prepaid expense for that particular item, it needs to say that you bought something, not that it was a deposit. Other possibilities, paying children. If you've got kids under age 18, you can pay them, and it does qualify as a legitimate farm expense. Now, two things there. One, you need to match the level of income kind of to the ability of the child. Obviously, you wouldn't pay a 6-year-old the same amount as you would a 16-year-old because a 16-year-old could do more work or do more things on the farm. But there are things a 6-year-old could do that could qualify as being paid to help on the farm. So there again, the important thing there is the children's income that you pay them is not subject to self-employment tax on the farm. So that saves the farm having to pay the self-employment tax. And of course, if they made over the 12,200, they might owe income tax. So you have to think about that as well. Income averaging is also another tool that farmers have at in their wheelhouse. You might say that other businesses do not have that ability or that allowance by the IRS. Income averaging comes into play, especially when a farm has had a high income year and the previous 3 years especially were not high income years. And it allows the farm to spread that income from that high year back into the 3 base years prior to that might have had a lower income tax rate. So it might shift income from a high income tax rate year to a lower income tax rate year. Many times, unless it's a fairly significant amount of income, it's not going to change it enough that it's worth the trouble of having your tax preparer go back and revise and resubmit that tax return from 2 or 3 years ago. But it is one of those things that's out there if we ever need it. Another tool that's worth mentioning too is that in many cases, especially this is handy for our row crop farmers, if there's a disaster or you get a disaster payment or crop insurance payments because of some sort of a calamity with that crop, it may be possible to defer the income of that insurance payment until the next year. The key thing here is the sale must be, or the income from the sale of that product must be, you must be able to show that it's your normal practice not to sell that product into the next year. So if a farmer raises corn, for example, and normally he raises his corn and puts it in a grain bin or puts it in storage somewhere and hangs on to it until till January, February, March of the next spring in hopes of getting a better price, if they can show that the majority of their corn is sold in that way, and that's their normal practice every year, and this particular year they have a disaster and they get a big crop insurance payment, because typically insurance payments have to be shown in the year you get the payment. But if they can prove that it's their normal practice not to sell that particular commodity until the next year, then they may be able to defer that crop insurance income until the next year. Otherwise, you're doubling up and getting income from 2 crops in 1 year, and you want to prevent that if at all possible. And one other tidbit I want to mention on this screen is timber sales. Quite often, farmers, especially if we're having a low income year, may look at other ways of generating income. And a lot of times they'll look at that patch of timberland that they've got, and they'll attempt to sell a little bit of that timber off. My apologies for the phone ringing in the background. And I emphasize there that it is very critical that the farmer maintain or establish a value or basis in that timber to be able to reduce that that net income from that net capital income from selling that timber, because they've got a basis established in that timber. Now, if you own a piece of land, you can establish a value in the timber separate from the value of the land itself. And that's what you would use that value in the timber. Obviously, you may need somebody to cruise the timber and establish a value in it to be able to have a number that is legitimate to use on a tax return as the basis in the timber on that piece of property. The challenge becomes, and I always get asked the question, well, I've owned that land for 10 or 15 years. and I didn't establish a value back when I inherited it or I bought that tract of land. Can I establish a value now? It is possible. That's always the answer. It is possible. However, depending upon how long you've owned it and what the value was of that timber when you bought it, is whether or not it's worth the time and trouble to get a value calculated in it. You can have someone do what's called a reverse cruise, or a back cruise they call it, where they calculate the value in the timber today and basically calculate back to what it would have been worth when you bought that land or inherited it, such as that. And that might enable you to establish a basis. That might be expensive. You might have to pay a timber consultant to do that. And is it worth what that cost would be compared to what it would save you in taxes? If it's a significant amount of timber, yes, it could be. But wanted to mention that on timber sales because it comes up a lot of times, and folks, I see often they'll put the entire sale of that timber in there, not realizing they could have saved themselves quite a few tax dollars by having that basis established in the timber. All right, other topics we need to get to. Like-kind exchange, and this is one that has changed a little bit the last 2 years. It used to be that when we traded equipment, it was called a like-kind exchange, and we'll talk more about that in a second. But under the new tax law that was created 2 years ago, the only like-kind exchange that still truly exists is only on real estate, land and buildings. And to qualify, there are very specific rules that have to be followed on how that exchange of, let's say you owned a tract of land out here, a good chunk of farmland, but you'd always dreamed of owning an apartment building in town. And you were had a friend that owned that apartment building that was ready to get out of the business. And you said, well, hey, I've got this piece of ground out here. Let's just swap. I'll trade you my, 30 acres for your apartment building and 2 acres in town. That can be done. And the nice part about that is it prevents you selling the land and having to claim a capital gain on it, and him doing the same, and then dealing with that issue. You can do a like-kind exchange between land, or 2 tracts of land, or a land and a building. But that you have to follow the rules carefully. So if you're considering doing that, I suggest you work with a tax preparer or somebody that's done it before to make sure that you follow those rules and don't get caught having to claim that income when you might be able to qualify it as a like-kind exchange. The big change we're dealing with now is related to sales of equipment, especially things like a tractor that you might decide to trade in on a new one. In the past, we were able to take that tractor. Let's say that the dealership gave us $25,000 trade-in value on that tractor, and the new tractor was going to cost us $100,000. Well, in the past, we could show we'd subtract the $25,000 from the $100,000. Now we've got a $75,000 value in the new tractor. The problem is they changed the law on us. We can't do that anymore. And of course, back then we'd depreciate the $75,000, not the full $100,000 that the tractor cost. Well, they did away with that capability, basically. So now, even though we trade in the tractor, we still have to show it on our taxes like we sold the tractor. Now, that may mean if we've taken depreciation on that tractor, we have to recapture some of that depreciation. That may be required. So we may end up having some ordinary income show up because we're having to recapture that depreciation. However, we'll now be depreciating or writing off the entire cost of that new tractor, the full $100,000 in this example of the new tractor. So the way it ends up working out in most cases, since we still have bonus depreciation and Section 179 and all that, often this still reduces self-employment tax because of the way the final calculations will work out. So anyway, that I wanted to touch on like-kind exchanges because it has changed a little bit, and when you're trying to do your records and keep up with that, hopefully your tax preparer is working with you on that fairly well. Got a few minutes left. Going to move on along to other topics. I want to touch on this one a little bit because it is a definite asset or advantage to farmers as well as other business people. When they changed the law 2 years ago, they created what was called QBID, the Qualified Business Income Deduction. This began in 2018 with the tax law changes for the 2018 tax year. I think they passed it in December of 17. This replaced pretty much what was called the old domestic production activities deduction, what they call DPAD. The problem with DPAD was many farmers didn't qualify for it. It had some very specific rules that a lot of times you had to have payroll expenses and such as that. And if it's a small farm, they obviously wouldn't qualify for the old DPAD. However, the rules are a little more flexible with the qualified business income deduction, and most, if not all farms, will qualify for it if they have a profit. Obviously, if it's not a profit on the farm on your Schedule F, then you wouldn't qualify for it, because this is basically what the deduction is. It's 20% of the gross income from that operation or from that business. So basically, you get to knock off 20% of the income from that farm or from that private business, whatever it may be, and don't have to pay taxes on that 20% of it. So you're only paying tax on the 80% that's left. Obviously, again, if there's no profit, then there's no deduction. But for farms that do have a profitable year, it is a nice little thing that we did get to knock down our taxes just a little bit more, hopefully. All right, net operating losses, touch on that just a little bit, because farmers there again have some advantages that other businesses do not related to net operating losses. There is a maximum each year of $250,000 if you're filing single, $500,000 for married filing joint. Now, there are some large operations that might have net operating losses larger than that, but that takes care of most of our small to medium to and even sometimes large operations. One of the things that's different for farmers is based on the current tax law, farmers are still allowed to carry a net operating loss backwards, what they call carryback, 2 years. So you can basically take that loss and carry it backwards. If you had a good or high income year in the last 2 years, you could carry it backwards, and that would reduce income in that year. That would allow you to submit that return from the previous year and maybe get some money back, because you wouldn't owe as much if it was a high income year a couple of years ago. You don't have to carry it back. You can carry it forward. So it's not mandatory that you carry it back. It's just that farmers have that option that other businesses do not. You can carry it forward, and you can carry it forward indefinitely until you use up basically all of that loss. Because the new law says that a net operating loss carry forward can only offset up to 80% of the of the gross income, of the taxable income. I get the right term there. Sorry about that. So you can't get rid of all your income in a future year with a net operating loss. You can only offset up to 80% of it. So having the carry back option for farmers does provide that possibility. Now, a lot of times, if we're having a good year, we'll say, well, next year might be better. It may be better to hang on to that net operating loss and carry it forward rather than carry it back. Or the cost of carrying it back into a past year would not save you anything on taxes, which makes it almost mandatory in a sense to carry it forward, or more logical at least. It is easier on the record keeping side for a tax preparer, of course, to carry it forward, because they're not having to go back and revise a previous year's taxes. As I mentioned there, non-farms are not allowed that carryback. Only farms are. So we still have a good advantage with that one. A couple other things I wanted to highlight. This one gets away, you might say, a little bit from income taxes, but I spend a lot of time talking about estate-related issues. And that's why I felt like it was important to mention a couple changes that took place this past year, especially, that's related to that. The current federal estate tax exemption for all of us, farming or not farming, is this year in 2020 is $11,400,000. Basically, which means unless your estate, when you pass away, if that should happen this year, unless your estate is worth more than $11,400,000, your estate will not owe any inheritance tax, or estate tax in this case, at the federal level. Now, if the state you live in has an estate tax or inheritance tax, it still might come into play. Luckily, Tennessee did away with theirs, so we don't have to worry about a state inheritance tax anymore in Tennessee, thank goodness. One of the things that changed this past December when the Congress passed the Secure Act was this lower thing that I wanted to highlight, and that's related to IRAs and 401ks. And that law changed as of the 1st of 2020, January 1 of 2020. They did one thing that I think was really nice, the other one not so much so. The nice thing they did for us was they changed the age at which we are required to start distributing money from an IRA or 401k. The year that we're what they call required to do a required minimum distribution. It used to be, prior to this year, age 70 and a half. At that age, we had to start taking money out of our IRAs and paying tax on it if it was a traditional IRA or 401k. A Roth IRA, you don't have to take money out of it any age. You can just leave it in there, but so they're not required RMDs. A traditional IRA or 401k is. So, but they increase that age to 72. So now we are not mandated to start the required minimum distribution until we're age 72. Folks are working longer, and with all this, health crisis that's going on now, we may all be working a little bit longer just to hang in there. The part of the law that changed that wasn't quite as nice was the change to the beneficiary withdrawal rules. Basically, if you pass away and you leave your IRA to someone else, if you leave it to your spouse, it didn't affect spouses. So spouses can still inherit an IRA from their deceased spouse, and it can become part of their IRA, or they can keep it separate, and then they would be required to start the distributions when they turn age 72 if it's a traditional IRA. If you leave that IRA to any other beneficiary, your son, daughter, grandchild, or whoever, they change the beneficiary rules. If in the past, if it was a family member, son, grandson, whatever, grandchild, then that child used to be able to spread out that IRA based on their longevity. So in other words, if you were already making distributions, they would have to continue doing distributions, but it would be calculated based on their age. So in the case of a grandchild, they might be getting distributions from that IRA for 30, 40 years until, they use it all up or they pass away. They did away with that, basically. In a sense, now all IRAs, traditional IRAs or Roth IRAs, that's left to a beneficiary other than a spouse. Now, there are a very few other exceptions to this, I will say that. But generally, they have to be distributed within 10 years. So you've got 10 years for that child or grandchild to take that money out of that IRA. If it's a traditional IRA, obviously they'll have to pay tax on it. I know you're already thinking ahead on this. If it's a substantial amount of money in that IRA, it's a couple $100,000 that you've socked away in that IRA that you might need, but unfortunately you pass away and aren't going to need it, and your beneficiary inherits it, and they're going to have to take 20,000 out a year. It may change their tax bracket if they've got to take that 20 out every year, or they could wait till the end of the 10 years and take it all then, which might be advisable for a Roth IRA. But in a traditional, they're going to want to take it out, probably in chunks a little bit quicker, so it won't affect their tax bracket maybe as much. All right, folks, we're about to finish up our time. I'll wrap up with just a couple more things just to emphasize, if you're whatever record keeping system you've got, you need to keep it as well as you can. Obviously, it's important to separate your family and home expenses from your farm expenses as clearly as possible in case you ever need to document that for an auditor or for any other purpose. A record system needs to be one that you're going to be comfortable using, that you will use, whether it's Quicken or QuickBooks or a spreadsheet. Whatever works for you is the thing to do. Here in Tennessee, if you need assistance in trying to create a better farm record keeping system, our managed program does help with that, and we're always glad to assist with that. And there again, contact us through your local extension office. I've about used my full hour. I've got just a few minutes left. I've noticed a few folks did have some comments there that, Mark, I appreciate that comment that the CARES Act has a component that allows someone subject to an RMD requirement to defer or not take that RMD in 2020 without penalty. And I thank you for reminding us of that. That is a very good point. I appreciate that very much. With that, if you've got a couple other questions you want to throw into the chat box, I'll be glad to try to answer them. I will emphasize again, I'll pop up my final screen there that I do have my email address there again. If you've got a question that comes up some other time that you're thinking of income tax wise, I'll be glad to try to answer it. Don't know everything. I'll be the first to admit that, but there are sometimes questions you can't find one. Maybe somebody to ask locally. I'll be glad to try to find an answer for you. Iris, somebody asked, will this be available for replay? Iris is recording this, and she will post it on her same site that she had this information come out on originally. So that will be available in case you want to listen back to some of it later. With that, Iris, I will unshare my screen because I know you need to ask a couple questions before we finish up today. And she's got a little questionnaire she needs to post up. So I'll let her take care of that.
Yes, if you don't mind, to answer these two questions, I just launched the poll. And if you locate your screen right now, there are two questions. If you could help me record those before you sign out.